So I've already written FS.Bartek Ltd statement of comprehensive income for the year ended 31st December 2013, and they are saying that from our question, the revenue is 256,200. The revenue is 256,200. We check from our question. Then we go to so we are recording revenue the way it is. We are recording revenue the way it is. Then after revenue, we normally less the cost of sales to get the gross profit. So from the revenue, that is after writing the revenue, below the revenue you write cost of sales. You write the cost of sales. So cost of sales, due to the note that we have just read, some items or some details may affect the value for our cost of sales. Some items in our income statement, not income statement, but in our additional information may affect the cost of sales. So you just write cost of sales, then you write working one. You want to work out the cost of sales. Remember, when I was explaining the format, we said that we don't come to add some items inside the statement of comprehensive income when you are preparing a question on published. You do your workings outside, and here you bring one figure. You just direct the examiner that you have working one, and that is how you got your cost of sales. So let's go to workings. So we write the workings. We prepare a table. We prepare a good table for the workings. So you prepare that table, as you can see from your screen. There is that table. You prepare that table. So you write cost of sales, administration expenses, sales and distribution, and the finance cost. Cost of sales, administration expenses, sales and distribution, and the finance cost. So that is our working table for our income statement. So you write working one to represent the working for cost of sales, working 2, the workings for administration expenses, working 3, the workings for distribution, that is a sales and distribution, and working 4 to represent the workings for finance cost. Then on the detail side, on the details, we have the balance as per trial balance. Balance as per trial balance. And the balance as per our trial balance, you should go back to your trial balance. Go back to your trial balance, and check the figure for our cost of sales. So as you can see from our trial balance, the cost of sales balance is 164,160. The cost of sales figure is 164,160. The cost of sales figure, then we go to admin expenses. We write the balance. The balance for our administration expenses is, as per our trial balance, we have a balance of 22,800. 22,800 is the administration expenses. We also have interest on loan note. So we said that finance costs is what represent our interest. So interest is our finance cost. So our finance cost here, as per the account, is 1,800. Then we have distribution cost. Distribution cost, that is sales and distribution. We have a total of 15,000. So those are the opening balances as per the trial balance. Then you do your adjustment. For each of them. We see which one is affecting what, and from our additional information, that is where we read our adjustment. So we can start from note number 1. We see whether it is affecting any of our items. So number 1, the company issued a shilling 30 million 6% loan note. The company issued a shilling 30 million 6% loan note on 1st January 2013. Issue cost of shilling 1.2 were incurred and are included in the administration expenses. They are included in our administration expenses. So if we can pause at that point, we can say that we are told that when the company was issuing a shilling 30 million 6% loan note on 1st January 2013, it incurred an issue cost of 1.2 million. It incurred an issue cost of 1.2 million, and we are told that that 1.2 million was included in administrative expenses. So I would ask you a simple question. So in our workings, we have administration expenses, distribution expenses, finance cost, cost of sales. When we talk over loan issue cost, where does it fit? Where does it fit well? Does it fit in cost of sales, administration expenses, sales and distribution, or finance cost? So, according to this question, we are told that the cost of 1.2 million was included in administration expenses. So, if you can look at this one, we can see that it fit well in the finance cost, in the category of finance costs. So what you are supposed to do is you go to your administration expenses, still in our working, that is working number 2, you less. So working 2, from your administration expenses, you less 1200. You less 1200 from admin, and you add 1200 to the finance cost. Simply you are moving 1200 from admin, you move it to finance cost, since that is where it is supposed to be included or to be posted. So we leave that one. We continue with that note. So note number 1, we continue from there. So the loan note will be redeemed on 31st December 2015 at a premium which gives an effective interest rate on the loan note of 8%. So according to our question, that one is not affecting us, since we are in the year 2013. This one, the redemption period of 31st December 2015 is after 2 years. So that one is not affecting our current financial period. So we go to note number 2. Note number 2, the company paid an equity of shilling 8 per share during the year. So that one, I said we correct that to be the company paid an equity dividend. The company paid an equity dividend of shilling 8 per share during the year. An equity dividend of shilling 8 per share during the year. So we continue with the note number 2. that is note number 3. Note number 3. And note number 3. The company's policy is to value land and buildings at depreciated cost. That is net book value, and that is the normal way that we use, or simply that is what we do. So we always record figures in our balance sheet at net book value. At net book value. So, due to a recent rise in the property prices, the company revalued its properties on 1st January 2013 to market value, and the independent valuer attached the value of the property at shilling 72 million. So we are told that an independent valuer attached the value of the properties, or simply the value of properties were revalued upward to 72 million. So they were revalued to 72 million as at 1st January 2013, 72 million. We also told that out of 72 million, land comprised of 14.4 million. Land comprised of 14.4 million, meaning the rest is buildings. The rest is buildings. Since this is the value for land and buildings, 72 million, land comprised 14.4 million, the balance is what was the value of the buildings. So as at that date, so buildings had a remaining useful life of 16 years. The buildings had a useful life of 16 years as at the date of revaluation. So the company will make a transfer from the revaluation reserve to retained earnings in respect of the realization of the revaluation reserve. So we are told to ignore tax on revaluation. Ignore tax on revaluation. So so we continue, and we are saying that in this one we are told that there is revaluation. Remember, when you get revaluation, it means that the value of our fixed asset will be affected positively, and it will also guide us when we are accounting for depreciation. Since we have been told that the depreciation expense for this year is not yet accounted for, and that is as per note number 4. So as per note number 4, we are told that depreciation at the rate of depreciation is not yet accounted for the year. So so we are supposed to calculate depreciation. So we calculate depreciation. We know land does not depreciate, it can only appreciate, but buildings will appreciate. That is, buildings will depreciate. You also have from our trial balance, we also have an item like equipment. So we have buildings as an asset and planted equipment. So the first thing that we are supposed to do is to separate. If we want to depreciate our buildings, we first need to separate. We separate buildings and the land. So we are told the value of land and building is 72 million. So how much represent the value of buildings? So you get 72 million, you less 14.4 million. The balance will be the value for land after revaluation. So let's find the value of land, the value of buildings, the value of our buildings. So we have 72 million you less 14.4, and you'll be left with 57,600. 57,600. So we would like to know the amount lard depreciated with. So how much did lard depreciate by? So lard appreciated. So lard appreciated from if you can check from our trial balance, the value for land was 12 million. The land was 12 million, and now after revaluation it was revalued upward to 14,400. So land was revalued upward by I hope you can see that the difference between 14,400, that is the balance carried down by the end of the year, that is 14,400 as per note number 3. As per note number 3, 14,400, and the value that we have at the beginning from our balance sheet is 12,000 to represent land, and therefore the difference is the revaluation. The difference is revaluation. It was revalued upward by 2,400. So what about buildings? What about buildings? Remember, buildings depreciate. And that is when you can check your trial balance. The value for land at the beginning, the value for land, not land, but yeah, the value for land at the beginning was 12 million, but land and buildings was 60,000. So you take 60,000, you less 12,000 to get that the value of land at cost was 48,000. So the value of land, the value for buildings at cost as per our trial balance was 48,000. That is at cost. Remember, buildings depreciate. And how much, as per the trial balance, how much was the accumulated depreciation of the buildings? How much was the accumulated depreciation of the buildings? Our buildings had accumulated depreciation of 9,600. So you can check there, it is there on our trial balance, 9,600. So 9,600 represent depreciation, accumulated depreciation of our buildings, 9,600. So if you are saying that the cost for our buildings is 48,000, you less 9,600, you'll get the net book value of our buildings before evaluation. So when you get remember how we are getting the cost of our buildings. Cost of our buildings, that is, land and building at cost was 60 million. 60 million, and you are told that land comprised of 12 million. So the difference is the cost of buildings, and that is the difference between 60 and 12 is 48,000. 48,000 is the cost, but we had accumulated depreciation of buildings of 9,600, meaning to get the net book value as at 1st January 2013, you'll take 48,000, you less 9,600 to get, so you take 48,000, you less 9,600 to get 38,400. So 38,400 is the net book value of buildings before revaluation, or simply as at 1st January 2013. 1st January 2013. So from that point, we have now known that at the beginning of the year, that is 1st January, the net book value for our buildings was 38,400. This figure was revalued upward to, so on 1st January we are saying that the net book value for our buildings was 38,400. So let us be together, 38,400. Then from there we know that our land and buildings land and buildings as per note number 3, land and building as per note number 3, we are told that they were revalued upward to 72, upward to 72. Note number 3, they were revalued upward to 72. That is note number 3. Property at 72 million. And the land, we are told that it was revalued, the land out of 72, the value of land was 14.4, meaning to get the value of the buildings, you take 72 million or 72,000, you less 14,400 to get 57,600. Remember, we have said that at the beginning, that is 1st January, before evaluation, the net book value for our buildings was 38,400. After evaluation, the value for buildings was placed at 57,600. So now you can tell me the amount buildings was appreciated by. So it is appreciated from 38,400 to 57,600. So after evaluation, but before depreciation for the year. After evaluation, the value of our buildings was 57,600, but that is before depreciation. So it was 57,600. So how much was the revaluation for the buildings? So you take 57 minus 38,400 to get that land, that buildings was depreciated upward by 19,200. I hope you are following these steps because they are very important. So the difference between 57,600 and 38,400 is 19,200. So 19,200 is the amount the buildings was revalued upward by. So then our main interest is depreciation. So how do we calculate depreciation for the year? Now I would like you to understand this. The moment we depreciate our asset, the depreciation rate changes. So we know that after evaluation, the net book value of buildings is now 57,600. The net book value of our building is now 57,600. And how do we account for depreciation for the year? Still in note number 3, we are told that Buildings had a remaining useful life of 16 years as at the date of revaluation. So we are told after revaluation, the buildings have a useful life of 16 years. Meaning, by the end of the 16th year, the balance for buildings will be zero. The balance for the buildings will be zero. Today, on 1st January 2013, the value for our building is 57,600. At the end of 16th year, the balance will be zero. So, how much is the depreciation per annum? Depreciation per annum for the next 16 years. So simply, we shall take the balance as per today, that is today after revaluation, 1st January 2013, we divide by 16 years to get depreciation per annum, So from my calculation, I can get that 57,600 divided by 16 divided by, so that is 57,600 divided by 16, I'm getting 3,600. So 57,600, if I divide it by 16 years to get depreciation per annum, I'm getting 3,600 per annum. So I can conclude that the depreciation for this year for the buildings is 3,600. And according to note number 4, the very last statement in note number 4, we are told that depreciation is classified under cost of sales. So you go to our workings, and include depreciation for the year for the buildings at 3,600. 3,600 on our working for cost of sales. Workings for the cost of sales. So that is the workings for depreciation for buildings. Remember, that is the step that you are supposed to follow. So from that point, let's go to calculation of depreciation for equipment, plant and equipment. So note number 4, we are told that plant and equipment are depreciated at the rate of 15% per annum. Plant and equipment are depreciated at the rate of 15% per annum using the reducing balance method. So reducing balance method, you just go to plant and equipment, you get the cost as per the trial balance, the cost of plant and equipment, you less accumulated depreciation to get net book value. The net book value times 15%. That is how we get depreciation per annum using reducing balance method. So 15% of the net book value. So when you go to our trial balance, where is the cost of our plant and equipment? So plant and equipment, as per our trial balance, plant and equipment is 100,440. 100,440 is our cost. You less accumulated depreciation. Accumulated depreciation for our plant and equipment is 40,440. 40,440, and the balance will be 60,000. That is the net book value before depreciation. The net book value is 60,000. So from that one, now you can account for the depreciation for the year. That is 15%. 15% of that one, we shall get 9,000. So 9,000, we are told that it is classified under cost of sales. Cost of sales, you go to your workings, the workings of cost of sales, you add depreciation on plant. So depreciation on plant, cost of sales, you add that one. So the fact that we don't have another item that is adjusting, we do not have another item that is adjusting our workings, we get the total for cost of sales, total for administration expenses, total for working 3, that is sales and distribution, and the total for finance cost. And from my workings, you can see that my cost of sales is 1767.60. Working 2, I have 21,600. Working 3, 15,000, and working 4, 3,000. Then you go to you post these figures in your statement of comprehensive income. You post these figures in the statement of comprehensive income. The statement of comprehensive income, just the way they are, and remember to write the workings. So we have a cost of sales. That is how I got 1767. Then revenue minus cost of sales, we get 79,440. Then we are supposed to add investment income. So investment income is as per our trial balance. We have on our trial balance we have investment income. You'll find it just the way it is. Then working 2, we had admin expenses. Working 3, sales and distribution. And working 4, finance cost. And that one will give you the profit before tax. It will give you the profit before tax of 40,320. So after getting the profit before tax, you less tax. So I would like us to stop at that point, and then we shall continue in the next session. So we are continuing. It's only that I would like to have just a small footage. We cannot go beyond that capacity. Simply let us record up to that point, and now I'll have the second session to continue from the profit before tax. So you check out on that.